Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. We're doing our weekly housing market update. I've got some super insightful information for you that's great news and kind of explains some of the things that's going on in the market right now and what a little bit more of what to expect for next year from the Trump presidency in when it comes to housing and mortgage rates. So let's dig right in. I'm going to share my screen with you here so that we can kind of jump right in. So some of this is going to be some quick headlines here and just a quick explanation of what's going on. Um, the new build housing market's kind of separate from the resale. And really the Fed doesn't really have necessarily a resale mandate, but they kind of look more at maybe some of the metrics of new builds, right? Because that's going to be the new inventory, and they keep an eye on that sort of thing, and maybe construction and how the permits and stuff are waning for new construction and all that. And we've got a lot of the 5 unit permits waning out. So that's all going to be coming to a head where we're going to see maybe some construction lulls there for, multi-unit properties. But when it comes to single family housing units, we are looking at, this idea that, just like a lot of people have been waiting for lower rates, the builders are waiting for lower rates to build more faster, to get more permits. And also, I think from the Trump administration, a big thing that we're going to see is a little bit less in regulating, with when it comes to things that they have hoops that they have to jump through for regulations and maybe even some of the permitting process. So we'll see how that all plays out. They're also talking about government lands. A lot of that's going to be in the west part of the country, which I've talked about before, as far as opening up governing lands, government lands to build property down, because really our new inventory comes from the new housing sector. Most people who are selling a property are also going to be buying a property. So you kind of have that neutral set data there. In the Phoenix area, it could be about 15, excuse me, maybe 15 to 20% of the properties for sale at any given time may be, investors or whatever. So there's kind of a quick look there. Now, two ways to look at residential construction slowdown. Obviously, we've got, these permits that have been slowing down, new builds slow down because of the higher rates over a sustained period of time. We've had these little, we're basically at recession lows when it comes to permitting for new builds and permitting for construction. Itself. And a lot of that new construction, when they say, here's what's available, a lot of that's just like I talk about all the time is dirt or just maybe in the permitting process. So that's all slowed down. A lot of it, has to do with these higher rates, of course, and the higher costs for builders too. And their margins, they're not dying out, but they're not the march of dimes either. It's not like quite like a situation, like we were in before, with the crash and all that. But it is, about a 20% margin that they're looking at by the time you get through all the regulations, red tape, and their fees and taxes and all that. So that the good thing about that is though is really can't go much lower, right? The people who have to move, people who want to buy, people who can afford to buy have been moving on and doing that. And I think the smart money's on them because over time, housing always goes up. And we're just getting ready to hit something I'm going to talk about here and give you a kind of an inside scoop on what's going on with things that are going to be happening next year. But right now we're missing about, let's say 1.3 to 1.7 million home buyers per year over the last 3 years, counting this year from 2022 to now, going into, next year will be the fourth year. So we're basically missing because of these higher rates and, economic situations that people have been in. We're missing about 4 million people from the housing market. 4 million. Okay. So there is this sense of a pent up demand for sure. For every 100 basis point drop, 5 million more people could potentially enter the market. Okay. But you know, we've got these buyers that are missing just because they can't qualify or afford to buy. It just doesn't make sense for them. And you know, I'll dig into numbers more a little bit here in a second, but that's you know, the mortgage applications is technically improved a little bit. You know, that data for under contracts and improvements up about 2%. So that's good news. Now, if it wasn't for those times of the year this past year where we had those lower rates, the data would have been even worse. But again, we are at, you know, for builder confidence, we're definitely permit and construction recession lows. Okay. Not pricing, but set the number of units being built. Okay. And the number of sales. We're really, you know, so we can only go up from here pretty much, you know, as far as the number of sales, as far as permitting, all those sorts of things when we look at things like you know tax reductions that are coming our way or you know lessen regulations and things like that that they're going to have to deal with but one uncommon pattern that we're seeing across the country and when it comes to you know the greater Phoenix area is we're kind of seeing a surge after the election like many of us anecdotally have been hearing over and over and over again from people you know they want to see what's going to happen with the election, right? So you know usually this time of year it's seasonal where you know listings will kind of cut off a little bit and then go up again after the new year. Well, we're seeing where they're still kind of going up, nothing crazy, but they're still going up. And right now, let me see. Oops, sorry about that. I had this already set up. Let me get this out of here. My, okay, I think my computer went a little wonky there. Okay, right now we're sitting at 21,837. You know, so nothing crazy. That's kind of a, as far as supply, it's, you know, kind of puts us in kind of a more of a normal, closer to a normal range of supply. So, you know, really more normal for us in the Phoenix area historically might be closer to 25 or 30,000 with lower rates and better demand. But, you know, we'll get there. We'll get there. So right now, that's where we are on supply because that's super important, obviously, to look at. So, um, what in the world happened here? Okay. So mortgage rates, you know, kind of staying flat right now as we come into the second term. Now, here is something besides the inventory that we want to point out is these mortgage rates. Now, here's a little bit of an insider scoop for us to think about. You know, the bond market is always ahead of the Fed. So when we look at the idea of you know, some people think, oh, the Fed lowered rates, so mortgage rates go down, right? Well, not necessarily, because you know the bond market usually reacts ahead of them. So a lot of this is already priced in as far as mortgage rates are concerned, because the 10-year Treasury is what we follow to kind of show us where we're going to be with mortgage rates. And when we talk about the splits, here's just for today. You know, so you could see the volatility there, and you can see the last 5 days. So the splits between the 10-year Treasury, okay, and mortgage rates are usually around 175 points or let's say 200 points difference. So right now if we're at 4.42, theoretically we should be at about, you know, 6.42 or a little less, right? Okay. So, but when you're you know, inflation and your economy's not quite in sync, and maybe let's say your Fed and Treasury, right? Then it causes a little bit of an inverted curve. So when you kind of throw all those things together, so you know, we've got one set of ideas from Powell and Janet Yellen. We're going to have a whole new set of ideas coming with the Trump administration. Now, whether or not Powell, you know, lives out his term, I guess he might, he's like the Wolf of Wall Street, not going to leave, even though he's slow and old and way behind on when inflation went up and when it went down, along with Janet Yellen. They both kind of were singing the same tune. Um, we're going to see the bond market already baked in a lot of this. So to get to neutral policy at 25 basis point cuts, which we're probably going to see one or, another one of those coming up here, and we'll see several next year. But you need to also have somebody in the Treasury that has kind of this idea that Trump has, where like Steve Mnuchin, who is the past Treasury Secretary, he's not going to be in this administration because he likes his current job. But anyway, he was quoted as saying, kind of the idea in Trump world is that we don't want this 10-year Treasury to go, definitely don't want it to go above 4.5. Okay. So if we can get the Treasury person in sync with that, then that'll be the pick. Okay. Obviously, there's other factors, but that'll be a big thing that Trump's looking for in his pick. And there's already been a couple names thrown out there, but I'm not going to speculate until they actually are official. And then does some of this, by the way, the unemployment numbers came out today, and they were like 213. Again, these could be revised. I'm assuming we're going to see some lagging numbers, let's just say, over the next few months that'll come out. But that said, we have to go by what they're giving us, and nothing new. We've seen lagging numbers before, but that's why we haven't seen this lower number that we're looking for, because the Fed and the bond market knows that the Fed is looking at those unemployment numbers. They've come out and said it. Yes, inflation does play a factor, but not like the unemployment numbers. So it's soft. The labor market's soft. There's indicators that they're soft, but it hasn't broken yet. So what would breaking be? Again, like we talked about in the past, if unemployment was 4.4, 323,000 jobs unemployed for a 3 or 4 month moving average. We've got right now today it's like 213. So that's why we're not seeing this dropping. But I hope that kind of explains kind of where we're headed, with the idea that the Treasury Secretary that will replace the current one will have the idea that we need to keep this down, even if we've got to spend the money in order to keep the Treasury number, 10-year Treasury, 10-year yield down. They're going to do it. Done in the past. And a lot of people are like, oh, the tariffs, he's going to do the tariffs. Well, by the time we rolled around to about 2018 to 2019, we saw that, the Treasury was under control with some of the tap dance that went on with some of the tariff wars, so to speak. We were bringing in tons of money from those tariff wars after that tap dance was over. And we saw rates were definitely under control. So, one other thing to along these lines is, home builders have been pay down rate. I'll tell you right now, if you are a home buyer thinking about buying a home, do not wait till January if you can afford to, and all that. Okay, if you can afford, do it now, because and let me know. I'll turn you on to number one. Builders are still offering incentives, but they're not going to be able to do this forever. Okay. And I'll get more into that in just a second. But they're basically, saying that, they really can't go on with this, with this buy down. It's costing them a fortune. So, but again, they're waiting for these lower rates too, and not where it dips and then comes back up. We need, 18, 24 months of lower rates, and this lower yield curve. So that can happen one or, two ways. And that's going to be, either we see the economy hit a snag on unemployment, okay, like I've been talking about, or we see the Treasury saying, look, Fed, here's what our policy is going to be. You should really get in line with this. Okay. Whether they do or not, it doesn't matter. They'll spend the money to do that, but it will automatically be a set thing to where we're not going to get, up to this level. Now, when we were at five, that's that 4.5 level, uh, which you can see we actually were in range of that. But the when this hit five, we were at 8% mortgage rates on average across the country. We want to stay away from all that, right? That's going to be the Trump policy, the Trump mandate there with his Treasury Secretary getting the bond market in line there, and that should drag the Fed along a little bit more. And until we can get Jerome Powell replaced with somebody who's not slow and old, we'll see the probably a little bit of a lag there because of that. But we know that the Fed is in a rate reduction cycle overall. It's probably, if they do these 25 basis point things, we're probably looking at about 5 to 6 more of them to get to a neutral policy. So hopefully they speed that up. You've got some Fed governors that are like, we should really speed this thing up because the housing market and other sectors are taking a hit. Manufacturing, the construction sector is taking a hit, and we're already behind the curve, and we don't want to go into a recession. So now would be the time to really shift course now that it's already too late. Okay, for sure. But you've got the slow and old people and the people who don't like people advancing and moving on with life and having families and buying things. So anyway, it's so true. The other thing to look at too is if your GDP is double, what you're doing as far as your debt payments and um, you know, um, your inflation rate. Those are going to be things to look at too. But this Treasury pick is going to be huge, guys. I'm telling you, that's going to be a big key here. We also talked about, of course, other things that are going to be in place like tax breaks, regulation breaks, all that stuff, which I talked about the last couple of weeks. So right now, the average, rate is just kind of hanging around there. Um, and again, we can see the shifts there. Now, what is the forecast coming up? Okay, this is what I wanted to get into. And before I get into that, let me go back to this for 1 second. The whole home builder ballooning cost. Some of the home builders estimate, like I said, their margins are still going to be about a 20% profit, but they're spending anywhere from 40 to 60,000 on, for instance, on a $500,000 house to help bring interest rates down for home buyers. Okay, so they're spending a fortune on this. Too many builders feel it's, kind of unavoidable and kind of mandatory to offer these buy down rates because really about 90% of the buyers that are doing it that are coming to them are using these buy down rates. Okay. The builders are not in dire straits, but they're saying they may have to kind of reevaluate what they're doing here in the new year. Okay. Again, I think a lot of this is going to take care of itself. Is it going to happen, overnight? Well, not necessarily, but I think we're going to see, again, better splits, because right now we just said 4.42, right? And today we're at, so we should be, like I said, at the most, we should be around 6.4. We're above that. So if our splits get better, which they have over time, but if the splits get even better, then automatically that helps because our economy's better. Okay. Um, so let's see a couple of other things here on this. You know, Basically the builders are just saying until we start to see those rates come down and become more affordable, we don't see this ending. Uh, and it's kind of required, but they are going to reevaluate. Because right now you can walk in, buy a brand new house. Um, some people don't like track homes, and I get all that, but a custom home, is quite a bit more expensive. So it's a good way to maybe get into a starter project, right? But you've got these, builders paying for your closing costs, which can be, around 2 or 3%, depending on the loan you're doing, maybe more if you're doing down payment assistance or something. And then they're buying down the interest rate. Okay. So, I mean, you're talking thousands of dollars. Like I said, could be 50, 60 grand on some of these properties, like on a $500,000 house. So, long term, one builder says long term, they're not worried because the incredible job growth and economy we've got here in the Phoenix area. We've got to get through this weird period with interest rates. And overall, some people are saying we have a great economy. I don't think it's that great. I think the underpinnings are not that great of the overall economy. I think Phoenix is a little bit better than some areas. Sure, it always is, but or it has been for quite a while. But anyway, I could go on and on about that. But the forecasts. So this is from the National Association of Realtors chief economist, and there's a lot of gurus out there with all of their predictions for next year. Lawrence Yun, who is the chief economist at the National Association of Realtors, said he's forecasting 9% increase in home sales for 2025. I would agree with that. I think people have sort of gotten used to these higher rates and they know prices are going to continue to go up just because there's not enough inventory. If there's not enough supply, even though resale listings are going up, that doesn't mean it's really a lot of extra inventory. Just to again put it in perspective, in the greater Phoenix area during the crash, we were at like 56,000 homes. Across the country, we're seeing anywhere from around 30 to 90,000 a week coming on the market across the country. Just a handful, of course, in the Phoenix area, a few thousand every week. But you know, we were in the greater Phoenix area, we had like 56,000. Across the country, we had about 250 to 400,000 homes coming on the market every week during the crash. Okay. Outside of the crash, if you take the crash away that everybody wants to get, there's so many clickbaiters out there on YouTube, the doom and gloomers. If you take that out, there was only one other year with economic factors like this. If you go back to the 80s, okay, that we're in right now, I know some things may be a little different, but basically kind of the same ideas, with inflation and all this stuff. We only had one other year where home prices went down, and that was like 1% across the country. Okay. So if you want to go, for the sure bet, I think, definitely still we have, we can definitely look at uh, the home purchasing being the way to go. So, homeowner worth, is definitely rising in this chart here. Unlike renters, homeowners gain equity 40 times higher than renters as far as wealth. The gap is growing as home values rise over time. Okay. And just in the past, like, 3, 4 years, I think it is. I can't remember if it's 3 or 4 years, but anyway, just over the last 3 or 4 years, guys, if you didn't own a home, you lost out on basically about $150,000 equity gain on the average home in America. So I don't know. You tell me. I don't know where you can do that outside unless you hit the jackpot of jackpot somewhere. Um, Anyway, so increase in home sales for 2025. I definitely think we're going to see that. I think we're going to have a year, like more of a normal year would be over 5,000. I'm sorry, over 5 million homes sold. We've been, well into the mid to lower 4 million range right now is kind of where we're headed. So, I think we're going to see a year where we see, 7 million homes sold over the next 5 to 10 years. I think we're going to see that, maybe even sooner, where I think we're going to see that, happen. So there's going to be a boom, like crazy. And you want to be part of that. And it's really easier than a lot of people think to own a home for those who maybe haven't done it yet. So, feel free to reach out for home values or, getting this process going, figuring out the best way to navigate all this for the best value and savings. Let me know whether you're selling a home, buying a home, or both. But and 13% for 2026. So he's saying 9% next year, 13%, and the number of sales is going to go up with mortgage rates stabilizing near six. Now, I personally think we're definitely going to be below six next year. Okay. We're going to get to the point where the average across the country is going to be below six for next year. And then, we'll be more like, in the mid to low fives by the end of next year. And then, I could see definitely the following year where we're kind of like around, 4.75 to 5.25, kind of more of a normal, what we're used to kind of a thing. Okay. So, anyway, that would be by 2026. But I think by the end of next year, we'll be somewhere between 5% and 5.5% interest rates, I think, by the end of next year. That's just my thoughts. Maybe 5.75 at the most. Um, and then he goes on to say, you know, it's been difficult on many fronts, the way things have been going. However, Young explained that household equity in real estate is at record highs. This means there's been a huge increase in wealth, for realtors and home buyers and all that. People have been doing really well with real estate. Okay. But he said basically when people work, when they have jobs and when they have, well, let's get real. A lot of these jobs that we're seeing in the jobs reports and stuff, they're part-time jobs or second jobs, or people are working multiple jobs. They're not like good middle income. I can support, four people in a household or five people in a household under one good middle or high, middle upper middle income job. Um, those are just few and far between compared to what we should be seeing. Uh, so he goes on to say that he feels like mortgage rates during the second Trump presidency, he's saying mortgage rates in his first term at 4% were the good old days. Are we going back? He says, my forecast, unfortunately, will not. We will not. It's more likely that we'll go back to six. That will be the new normal, bouncing around 5.5 to 6.5. I think that's exactly what we'll see over the next year. I think we go beyond that into the second and third year. I think we're actually going to be a little bit lower than that. That's just my personal opinion. But at least, if we can get, a five in front of it, right? We're doing good. We're doing good. At this point, if we can get a six in front of it. And guys, when we saw it hit six, we saw, mortgage application data and under contracts and all that go up. So it just hasn't been long enough for a sustained period of time. Um, so, anyways, he goes on to say that, obviously all this comes down to mortgage rates, guys. And so, we've just really got to, sorry, my whole thing here went crazy because I think my computer did, or my internet went offline for a second and everything jumped around. Okay. So anyway, it comes down to getting these mortgage rates down, guys. That's the bottom line. For builders, they're saying it, but a lot of people are waiting after the election. A lot of people are jumping back in the market right now. That's super smart, especially this time of year, especially in this market right now at this time, because as people kind of do get used to this, their wages finally maybe catch up somewhat with inflation, even though a lot of that crazy inflation's baked in and, it's super hard for everybody right now. It is a factor when those rates come down. We're just going to see, like I said, right now you've got about 4 million people just sitting there that couldn't buy over the last 3 years that, there is that cycle of pent up demand. So, right now, the greater Phoenix area, this is the Crawford Market Index. That Crawford Market Index, if it's between 90 to 110, that's a balanced range, 100 being completely balanced. Below 90 is a buyer's market. Over 110 is a seller's market. Supply is, so if we were trying to be at 100 dead center, kind of for normal supply, we're 22 points lower than that. And for demand, we are, I'm sorry, 12 points lower than where we should be, and 24 points, just about 24 points lower than where we should be on demand. So right now we're in a buyer's market. That means if you are thinking about buying a home, for the most part, and every area is going to be a little bit different, but really there's no like huge advantage to sellers right now in any area of the valley. Okay. There just isn't. Okay. I'll talk about that in just a second. But right now we are in a buyer's market, period, end of story. So if you are thinking about buying a home, right now is the time to do it. Even though rates are higher, even though prices continue to go up, I know it's tough, but you can get but what we can do to kind of counteract that is get your closing costs thrown in either with a new build or resale, a lot of times with incentives from the builder or sellers, and even more importantly than a price reduction, which on an average home may save you like 88 bucks a month, with a rate buy down, whether it's 3-2-1 or 2-1 buy down, those are the years. Okay, then it goes to fixed, or just a regular fixed rate buy down. I mean, you can save anywhere from $200-300 a month or more. Okay, just depending on which program we go with. So that can help shift. And I've seen, I know there's properties out there, and builders right now in their incentives, let's say on a $400,000 house, your payment is going to be right around $2,200-2,300 a month on a $400,000 house. With some of the rate buy downs they're doing now, there are some a little bit less expensive than that. I mean, they kind of start around $1,900 a month, including HOA, right? So the average rent right now in the greater Phoenix area is about $2,300 a month. Okay. So 2,300 in a mortgage or 2,300 in a rental, maybe even a little less if you want to go a little bit smaller. Okay. But so why rent when you can buy? Okay. It's kind of a no brainer. Anyways, we'll keep an eye on that. And then this tells us kind of where we're headed more like right now. So we know where we're going to be in 30, 60, 90 days, because this tells us the active to under contract ratio. Okay. So that's kind of where we are right now with the active count. This shows it. Let's see, this came out. This is the latest one on the 18th. Today's the 21st. Obviously, the active count shifts a little bit, but the contract ratio is at 31. So in order to be in a hot market, okay, just to give you an idea here. Whoops, let me switch back here. Uh, okay. So here's a map of the same thing, but just kind of giving you the different areas. Here's kind of the contract ratio ranges and chart by color according to the map. So right now, your only kind of hot area is right here, and that's in Tullison, which makes sense because things are pretty affordable right there. Okay. Um, so under contract at 65, just over that hot mark, with 100 actives. So that tells us there's, quite a bit of actives compared, or quite a bit of under contract compared to actives. So contract, ratio is hot there. But if you look at most of the rest of this, you're kind of, balanced to cold, right? So um, just keep that in mind, right now, because I think, in a new year, things shift automatically. Just again, it's a seasonal thing, right? But this tells us even better than the index. Okay. This tells us even a little bit more where we're headed because we can see, okay, in this area under contract right now. So when you go under contract, that could mean, maybe 30, 60 days out, right? There's, a closing. So it kind of gives us a little bit more of that range on what's happening in the market right now. Now, as far as areas that are on the upswing towards a seller's market, that would be Chandler, Cave Creek, Phoenix proper, Avondale, Tempe, Peoria. Now they're on the upswing. But as far as the cities that are actually in a buyer or seller or balance market, we're looking at Fountain Hills, Chandler, and Scottsdale and Cave Creek, Phoenix proper, Avondale, and Glendale are technically all in seller range on the Cromford Market Index. But It's like minuscule. Like Avondale's at 113, Fountain Hills at the highest is at 141. But again, to give you an idea where we were just, back in 2021, those numbers were like high 400s. So it's not anything crazy. Advantage to sellers. Um, we've got Mesa, Tempe, Gilbert, and Paradise Valley, Peoria. Those are in balance markets, and then everything else: Surprise, Goodyear, Queen Creek, Maricopa, and Buckeye are all in buyers markets. So I hope that kind of gives you an idea on where we are right now, what the outlook is. Um, Again, just a New Year seasonal thing. We should see kind of an uptick after, into about the second to third week, fourth week of January is pretty typical. And then tax season, of course, people, file their taxes, maybe get a little bit of money for down payments and things like that, or to make their move. And then all this other stuff that we've been talking about with what's coming with the new Trump administration, what their strategy is, which I feel is going to be really good for housing. So, and the economy. So, guys, if you have any other questions at all, feel free to reach out anytime, and we'll get you more information about your property, your area. If you're thinking about looking at, or just general questions about what's going on there, or if you're thinking about purchasing a property, how we can make that happen for you, I'd love to be able to get into the details of that with you anytime. All right. Thanks, guys. We'll talk to you next time.